Everyone, welcome to another episode of Sitting Down with Matt and Mark to have your questions answered. That's right. Each and every week, we take questions that are asked on my primary channel, Mark Moss. As I'm doing those videos, I'm asking for people to ask questions about those videos. We're grabbing 2 questions from each video each week, and we're answering them over here on this channel. Now, when we answer your question on this video, you are able to earn $25 in Bitcoin just for asking the question. We love the questions. We love to answer them over here. The catch is that you have to ask them on the original Mark Moss channel, and you have to be watching these videos to see your question asked or answered, and then let us know down below. Just send us a comment and we'll go ahead and hook you up. So anyway, with that, let's go ahead and just jump right into it.
All right, Mark. So I got another question for you. This one is from the Fed pushing asset prices on your main channel, Mark Moss. So this question came from Nick 007. Hi, Mark. Your videos are always appreciated. Thank you for taking the time to do the research on this gold mining company. It's very interesting. I do have a question though. I was wondering how the value of gold that the company pulls out of the ground is converted into the value of the stock. Will the company buy back its shares, or will they provide some sort of dividend? Thanks for taking the time, make all these videos. Kind regards, Nick.
Yeah, that's a great question, Nick. Thanks for asking that. So if you remember last year, Warren Buffett bought a gold company. That was a really big news. Warren Buffett has been outspoken critic against gold for a really long time because he says that gold doesn't produce anything. It doesn't do anything. So Warren Buffett has built his career off of buying productive assets, productive businesses. So he wants to buy businesses that produce things, and he likes them to be very capital efficient. So that means companies like Coca-Cola or See's Candy that he holds, because those brands, Coca-Cola is so big, all it has to do is sell soda, and it actually doesn't even sell the soda. The bottlers have to make it and distribute it, but it can create revenue just off of its name brand, and it doesn't have to put money back into research and development. So it's very capital efficient. So he likes those types of businesses. Gold doesn't produce anything. All right. So he ended up buying Barrick Gold because gold, it wasn't gold he was buying. He was buying a company that produced something. And what did it produce? It produced gold. Now, to your point, when a gold mining company pulls gold out of the ground, how is that converted back to the value of their stock? Well, just like any other stock, which is, PE ratios, price to earnings. And so it's no different if they were selling soda or chocolate. They're selling gold. So what is the cost basis to get that gold out of the ground? And what is the retail value? What do they sell that gold? That the difference is their profit, the spread. And so how much profit are they making? How efficient are they running their business? Are they dumping a bunch of money back into R&D? And then, so how much profit do they end up having? And then, of course, to the second part of your question, which is, what will they do with the profit? Will they buy back the shares? Will they release dividends? Well, different companies do different things with it, of course. So there are companies that pay out dividends. Maybe some of them buy back their shares. Maybe some of them take that profit and go buy new gold mines. And so each company is going to be different in what they're doing. But what I would say is that when you're looking at gold mining companies, trying to evaluate gold mining companies, you're just looking at them as a normal company. And just imagine that gold product is any other product. It could be an iPhone or it could be a chocolate bar. But it's, what's my cost? What's my profit? What do I do with those profits? How do I treat my investors? And so forth. And so that's how you would look at it in a big way. Now, when gold goes up by, $500 an ounce, maybe it goes from 1,700, up to 2,200, 2,300, $500-600, that's pretty good. If you bought gold at 1,800 and it went to 2,300, like you made $500, that's pretty good. But if you're a gold mining company that has 1 million ounces in the ground, well, now that's 5 million, right? So it's exponential, the way that gold moves versus gold miners. And what happens though is their cost of producing that gold is fixed. So each mining company has a fixed cost. So say it costs them $1,200 an ounce or $800 an ounce. I think the one in the video, their cost to get gold out of the ground is like $880. So call that $900. So if gold is at 1,700, they're making $800 an ounce. But if gold goes up to 2,300, see how much their profit goes up. And of course, just like any other company, if their profit goes up by double, the company's worth a lot more. Does that make sense?
Yeah. You know what this reminds me of? When we were back in Arizona back in October, and we were sitting with Robert Kiyosaki. He said, My wealth is my brand. My net worth is my brand. So
Mhm.
you can relate that directly to mining companies. So their face is the brand, but their product is the gold. And let's say your company is worth $100, and like you said, you're sitting on a stockpile of Pokemon cards, and you don't even know anything about it. But yet the Pokemon skyrocket in value. Now your company's worth a lot more because you hold all of it. It's like a lot of these companies are buying Bitcoin, and then the Bitcoin skyrocketing, and now the company's market cap is a lot larger.
Right.
Their resources and means of funding and um, their cash is just a lot larger now, just due to the assets rising in price.
Right. Yeah. Yeah. So I think a lot of times you can kind of get confused and start to think that things are different. But like I always try to break things down to the most basic. And so in light of that, like I said, just look at gold as a chocolate bar. I mean, it's just they're producing a product, they're selling a product. What's their profits? What are they doing with the profits?
Yeah,
And it's pretty simple
simple.
from that standpoint. The
Pretty
difference
sure.
is the difference is though is that if I'm selling an iPhone, then my not only my sales price is somewhat fixed. Like each new iPhone maybe costs a little bit more than the one back in the past. But or whatever product might be, Coca-Cola, like maybe I can raise the price of that Coca-Cola a little bit to keep up with inflation. But gold could all of a sudden just double. So
Yeah,
that changes like a big time. So you're kind of when you're buying a gold mining company, obviously you're buying it for the profits, but you're also sort of speculating on the future of that product's price in the future. So if I'm buying Apple stock, I'm not really betting, I'm not speculating on the price of iPhones going up. Maybe I'm speculating on them coming up with a new technology at some point, but really I'm buying them for their earnings. Whereas gold, I'm buying them for their earnings, but I'm also speculating that I'm buying them when gold's at 17, 1800, but when it's 2300, it's going to be worth a lot of money.
yeah. Definitely got to be a gold bug to have the knack and see the eye for good companies. See where they're exploring, where they're going to drill, and see their future prospects of where they're headed. That's always
Yeah.
a good way to gauge it. All right, so thank you for that one, Nick.